Jerry, thanks for joining us. I know stock prognostication is always difficult, probably especially difficult when we're still living in this ongoing pandemic. What are some of the big themes that you're watching next year that are helping to mold your portfolio picks before we get to the picks specifically?
Yeah, so again, the interesting thing about this entire experience is it didn't just turn on and turn off, right? There's been waves of pandemic. We're on our third variant, right? And the reaction in markets to each of these waves has been somewhat different. But from our perspective, it's kind of given us some clues on where we're going to go in 2022. Biggest and most important thing is we've had this experience now where rates would be super low forever, and you could discount the fastest growing companies at insane multiples. That seems to have that ship seems to have sailed. And your point recently about the comparison between MasterCard and the fintechs is a great example of that. We see this ebbing now into a more durable cyclical expansion for 2022. And even if you don't see it walking in your office next week, don't be surprised if the market begins to focus on the things that will be more than well taken care of as the economy globally comes out of this, and we're much less worried about another variant and its effects.
And so as we spoke in the intro, financials are the most popular idea for investments, according to our survey going forward, which seems to make sense if interest rates are finally going to move back up, as the Fed has at least hinted it's going to do. Of course, the timing of which is still up for debate. But then technology is still popular, coming in at third. But if you've got rising rates and these valuations that are still quite high and stretched, does that make sense to you looking forward?
Yeah, so the way we look at technology is you really have to separate the companies that are self-financing from those who aren't. So if you're a high multiple company or a high multiple stock and your business requires capital over time, you really need that stock valuation to stay high to attract the capital that you can redeploy in your business. That's not true, for example, of a Apple or a Microsoft or some of the more established companies who are well into their growth and cash generative mode. Those companies do well and don't require a super high valuation. And you've seen this in this most recent sell-off, right? The names that a lot of folks enjoyed and loved during the pandemic have not really bounced here, while the Apples and the Microsofts and these other more durable names have done quite well. And we see that trend expanding into 2022. So be very careful which type of tech name you own.
Hey, Jerry, Frank Holland here. You're very bullish on cyclicals. I know you said it's not going to start on January 1st. But in general, I wanted to ask you, I know in particular you're bullish on Ford and Las Vegas Sands. Cyclicals in favor for a lot of people, but they're also the most sensitive to inflation, where we saw core PCE up 4.7%. And also supply chain issues, contrary to belief, they haven't been resolved. How do these cyclical names deal with this increased cost? Do they have more pricing power even though stimulus is winding down?
Yeah, so the pricing power question seems, again, for cyclical goods. Boy, if you haven't been able to buy a car for the last year and a half, is it going to bother you if you have to pay another 5%? On sticker? If you go and haven't had a trip out to Las Vegas or any entertainment venue for the last couple of years, again, you're already seeing the response to higher prices. Consumers are absorbing this, and it's more a pent-up demand side, and then roll over into gasoline, which we didn't mention, but the same thing you see with all-time high gasoline consumption numbers and relatively high gasoline prices. That tends to tell you how much run you probably still have in all these cyclical names.